all CEOs, me included, we don't actually know what we're doing.
They're all sharks, so all you got to do, though, is know shark behavior.
I don't think we've ever talked about this before, guys.
We can capture all of the wallet share.
First place you start is with the product.
That's just the first nut.
This is the Capital Stack. Hey everybody, this is David Pohl, the host of the Capital Stack podcast, where I talk to founders, operators, and investors about all things value creation and startups. Today I am talking to my man crush, Sheldon Lewis, who is the managing partner at Blueprint Equity, which is a growth equity firm in San Diego, California. Working on close your second fund, right, Sheldon?
That's right. Yeah.
Congratulations.
Thanks. And thanks for having me on. It's a privilege.
Yeah, my pleasure. I've been following your work for quite some time. I'd like to just kind of start off, Sheldon, talking a little bit about Blueprint and kind of like what is growth equity and like how is it different than venture capital and
Definitely. Yeah. It's everybody, it's kind of funny. Everybody has their own definitions. And even when we were fundraising, LPs put you in different boxes, even though you're the same to yourself at least, which is kind of interesting. But we consider ourselves early growth equity. So we kind of are a hybrid between venture capital and growth equity. And so the way I see it, there's really three buckets of investors. There's venture capital, which is, there's multiple buckets, but if you really want to break it down into institutional investors, there's three. There's venture capital, there's growth equity, and there's private equity. Venture capital, you're coming in the earliest, you're taking the most risk. Your loss ratio is quite a bit higher, so your loss ratio is probably 80%, but the 20% that are winners end up being huge winners because you come in so early. Then you got growth equity, which is kind of in between venture and private equity, where you're really still focused on growing the business. Burn is it's still okay to burn, but the goal is to eventually get to profitability during your hold. The loss ratio is almost inverse. It's probably 20%, as opposed to 80%, but you lose out on a little bit of that upside. And then there's private equity, which is, kind of the business is in, it's not in its infancy by any means. It's in its, later stages. You're definitely focused on profitability. The investors that are investing are using debt and kind of financially engineering an exit and looking for, a 2x or, at most a 3x return. So we kind of sit in between venture and growth, and consider ourselves early growth. So we like to think that hopefully we won't have our loss ratio will be zero, and knock on wood, so far that's been the case. But we think it'll be a lot lower, but we still get the upside of coming in early, and so where we usually come in is kind of the 1 to 7 million in revenue stage. So it's not a concept. It's definitely a proven business, but it's still early in its life cycle. And then we really try to, supercharge that business and get pretty involved in helping it make it to that next stage of growth.
And it's all minority investment. So it looks and smells a lot like venture capital, and the fact that you're sitting as a minority investor, you have a board seat, but ultimately management is still founder driven. Absolutely.
Yeah. So all minority, but I'd say as opposed to most of our peers that are also minority investors anywhere around this stage, we are pretty hands-on, assuming the entrepreneur wants us to be. It's 100% up to that entrepreneur. Some entrepreneurs say, hey, I want to do 99% of this myself, and we say, fine, that's great. But we kind of present to all of our entrepreneurs almost a Chinese menu of things that we can help with and that we've helped with in other companies. We've invested between me and my business partner in about 30 businesses now. And so we've seen all B2B SaaS or fintech or tech-enabled services. So we've kind of seen this movie before, even though we're an earlier stage fund, and so we can be helpful. But obviously, we're not forcing our opinion or our involvement. Where like a lot of majority investors and kind of on that note, we're one of the things that's kind of unique about us that I think the entrepreneurs we've had the privilege to work with appreciate is we have and are in the process of expanding our an operations team where we can actually have someone to help them out with recruiting or top of the funnel go to market or kind of more typical go to market sales and marketing and of course financial modeling, building budgets, KPIs, reporting, and really preparing them for that exit or the next round of financing, whatever is best for that individual company.
Yeah, no, and it's really great. I mean, especially if you're gonna offer that post funding to get all that set up and diligence anyway, because then you actually have the operational framework for them to report to you because you're seeing the numbers the way you want them to be seen and not their interpretation. Definitely,
yeah. And most of the companies, it's our diligence process is kind of enlightening, obviously for us, but also for the entrepreneur. But a lot of times it's the first time they're really digging in and running some of these numbers themselves. So it's a good exercise either way. But you're exactly right. It's one, good for our knowledge and probably most importantly good for both us and them to just kind of steer the ship the right direction. But two, you get the benefit of having those numbers and like you said, knowing how other investors are going to see them, so that when you do take the business to market to either raise money or sell, you're kind of eyes wide open about the intimate details of that individual business. So when you're thinking about this early growth equity stage,
it's so interesting. Like the more and more I've been in this field, and it's not been very long. I think it's been like 7 or 8 years or something. But I've seen so many like incentives, perverse incentives in just generalized fund structure, right? And the fact that MOM, multiple on invested cash, or MOIC kind of trumps IRR because you can get paid out more, continuing to push the envelope, pushing, the company to get further and further from an enterprise value perspective. How do you think about your fund math and taking liquidity and hold times?
Yeah, it's a good question. And it's kind of interesting because every LP has their own answer. Some will tell you they're more focused on IRR, and some will tell you they're more focused on MOIC. Both are important. And just for the entrepreneurs or other folks out there listening, IRR is how quickly do you get your money back, versus MOIC is what is the multiple on the money that you invested that you're getting back. And so both are important. You want to pay people back as much as you can, but you also want to pay them back quickly because they want to put that money to work in something else, either your fund
and generally, and an MOIC calculation generally means that you're actually following on and putting more money in. So your multiple on invested cash will be lower because your cost basis gets higher, but your ending payout hypothetically is going to be much higher. Right. So I mean, I personally, I think we were pretty fortunate where we had a couple big wins last year, and it was we didn't need to raise money in both situations. And this is kind of our favorite thing is investing and getting businesses to the point where they don't need capital, because then they become that much more enticing to whether it's strategics or just upstream buyers.
And that's what happened with two of our businesses last year, and both were great outcomes where we sold a third of one and 2/3 of the other, but didn't need to. And because we didn't need to, I think we could kind of ask for higher multiples and demand more. And so this kind of goes back to your question on, when do you realize returns? Part of it has to do with the market, and no one has a crystal ball, and it's everyone's best guess on what it's going to do. But you can generally say, last year, things were pretty frothy, and right now things are have clearly kind of gone the opposite direction. And so, most investors, hopefully we're able to get some chips off the table last year, because this year it's probably not going to be as easy to see especially the valuations and the returns. But to answer your question, I think personally I'm more concerned about I'd probably give the MOIC the slight advantage over IRR, but getting people their money back quickly is also important. So yeah.
And so, talking about valuations, right, and thinking about how they were last year. I mean, like for realizing liquidity, I'm a coward. So whenever somebody offers me money, I'll take some, for my shares. Usually as long as it's up. It doesn't mean I'm going to sell everything, but I run everything through special purpose vehicles at my firm. So when I'm able to do that, I can go back to those same people and say, hey, do you want to play again? And generally the answer is yes, right? So it's definitely good for me. However, I do know I'm forgoing upside. So when you're thinking about like valuations, and like how much like the companies can go for, there's been so much change over the last 7 years where, I've generally seen things kind of normalize, around 7 to 10, and then they went from 10 to 12, and then it was like 15 to 20. Mm-hmm. And now they're kind of in this nebulous, kind of area where no one knows where anything's going to go. How do you think about valuations right now, and where the buck's going to stop on this? And are you looking things at a current ARR basis? Or are you looking at like where they're going to be in 12 months? How do you think about that from the stage that you're investing in?
Yeah, it's a good question. It's been a really interesting dynamic over the last 12 months, as I know you've seen too. Because, it was kind of last year, even at this time, it was, grow at all costs. It was so easy to raise money. Everyone was, throwing money at anything and everything, kind of the A companies, I think, and I hear this all the time talking to other investors, the A companies are still getting funded. That hasn't changed. And they're still getting decent, pretty good valuations. My favorite Warren Buffett quote is, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price, meaning, good investors are still paying up for good companies, but the dynamic that's changed is those companies that were kind of the B and C tier, they're struggling a little bit more getting funding, whereas a year ago they could you could throw a baseball in any direction and land on something. So we've at Blueprint, of course we subscribe to the kind of Warren Buffett way of what I just said. Make sure you're investing in a good company more than just getting a great price. So we have paid up for companies, and we'll continue to do so for great companies. But the world has changed, and I think everybody needs to take that into account, not only investors but entrepreneurs too. And so where a year ago, maybe an entrepreneur had a number in his or her head. For better or for worse, the world's just changed, and they need to make sure that if they need to not optimize purely for valuation, and my advice would be more focused on finding the right partner. So I don't know if that answers your question, but but multiples have certainly come down in the market over the last 12 months, and where do I see them going? I think it'll probably be a tough year this year, but we'll see. I don't know if I answered your first question, which is how are we valuing companies? We're usually looking at current ARR and giving a multiple on that. Of course, we take into account what the projections are going to be, but I'd say kind of in order of what's important, at least to us, is growth is number one. Historical growth, we look for at least 75% or more year over year, and most of the companies when we're coming in are well over 100%. But then second to that, margins are super important. Burn is important. Market size. We're obviously looking at the other key metrics like CAC and LTV and magic number. So all those things are important. But yeah, anybody who didn't say growth was the most important would be lying to you.
I feel like kind of around that Series A stage, you have a choice of kind of what type of potential partner you're investing in and what outcome eventually, or really the strategy of what your company has to be happens, right? So, and maybe that even happens in seed. I mean, seed got so frothy too. I think in 2021, the average seed round was like $5 million. So, you're looking at it, $20 to $25 million post money, where in normal times, if you're doing a current ARR multiple of 8, you're still underwater, when you're at a Series A. So you really actually are put into this binary situation where you have to justify TAM and a venture-like return.
Yep. Yeah, it is pretty crazy. And I always urge entrepreneurs, we kind of run into this wall sometimes with companies, especially now, where they raised at these, crazy high multiples previously, and maybe it was angel money or friends and family or seed, but that kind of sets the bar really, really high for them. And, they're stuck, kind of in between a rock and a hard place, because of course they want to maximize value and get the best valuation possible. But, if the bar is set too high, if their last multiple was 50 times revenue, well, it's harder to do that in, the kind of the larger you get. There can be some kind of multiple compression. And so what you don't want is, you raised at and I'm just throwing numbers out there, but you raised at a, $40 million valuation for your business that was doing $1 million in revenue. And now you're going back to market to raise a Series A and you're doing, $2 million in revenue, which is great. You grew 100%. But a 20x multiple, if you're looking for an institutional investor, it could be hard. Maybe you got a terrific product and team and you can make it happen. But then all of a sudden, no one wants to do like a down round and to have to go back to their investors, their early investors, and say, hey, we're not worth what you paid a year ago. So I would just urge entrepreneurs everywhere where, of course, valuation is important. Your equity is precious and you want to hold on to as much of it as you can. That being said, don't get too hung up on it, because if you get to a good outcome, a good exit with the right partner, it's not going to matter. You're going to have plenty of money. And so don't worry about, kind of rounding errors. And I would say, focus more on a partner that's going to help you optimize that eventual outcome and that eventual exit. And that could be helping you through, operationally, through go-to-market, recruiting, finance. It could be helping you with that exit. It could be helping you with just, advice and being a good, kind of sounding board. But yeah, whoever it is, just make sure, whoever you partner with, you number one, you trust and you like. Can't tell you how important that really is.
Mm-hmm. How do you think about, fund structure, like how many companies that you have, fund one versus fund two, check size, diversifying that risk. How do you think about that one?
Yeah, I mean, so for us, so we're fully invested out of fund one and investing out of fund two now. Fund
one was 75 million, right?
Right. And so we had 8 investments in that. So it was a pretty concentrated portfolio. With fund two, we're going to have more investments. It was a good step up for us. So it's a $200 million fund. And we really think we found a sweet spot where we're investing now. So we didn't want to move out of that. And so with the larger fund, we will have more investments because we want to stick to the same types and size of the businesses that we invested in with fund one and had success within fund one. So, fund two, it'll be a little less diversified, but probably, 15 companies or so. I don't really subscribe to, and there are great VCs out there that, prove this wrong, but I don't love the, kind of 30 companies in a portfolio, or more. Some funds have even more than that. I just think that it's hard to, that game's a very different game than we're playing. That game is more that VC model we were talking about earlier in the conversation, where you're kind of just home run hitting and unicorn hunting, and out of those 30 investments, 2 of them will be awesome outcomes that will hopefully return the fund and some, but the other 28 are not so great or just complete duds, complete donuts. So I get it. I get that strategy. And I think, maybe that strategy works a little bit better for, the earlier you are. But it comes with a couple sacrifices. And one of the most important ones is you just can't, give the time and attention to each company that, that they deserve. If you're making 30 or 40 investments, that managing partner is probably sitting on 10 or 15 boards, and in between fundraising and sourcing and everything, they're not giving you any time. And especially if you're not one of those 2 top performers. So I think, as the entrepreneur, that's something to think through, but also, from the investor side, we kind of like a more concentrated approach, because you can have, we think, if you do your job right and pick right, it's a lot easier to have outsized returns.
Yeah, I mean, considering how hard it is to get one deal done, right? Like if you're actually doing the work and doing diligence and understanding an industry, I mean, and sourcing and.
Totally. And that's a good point. A lot of times, if you're making that many investments, you're not doing the right work.
You're not doing any work. Yeah, you're just seeing who else is in it, right? And then you're underwriting to see, can they be funded again? How good's the founder at, selling and
totally
getting your way up there. So that's really exciting. And so you said you're going to keep to the same sweet spot. So same exact series, kind of $3 to $5 million checks. Is that right?
And a little bit larger. So fund one was 3 to 10. $3 to $10 million checks, and then fund two is 5 to 15. So
5 to 15.
Yeah, but I'll kind of give you the high level parameters. Yeah, same as fund one. So B2B software is our primary focus, but we also look at fintech and tech enabled services. A business is doing, call it you could say 1 to 10 million in revenue, but I'd say our sweet spot's really 1 to 7 at point of entry, growing 75% or more year over year. Bootstrapped or capital light, so we are usually leading that Series A, and usually the first institutional investor involved. That's not always the case. Maybe there's an institutional seed investor, but most of the time we're the first institutional investor involved. Always take a board seat. Like I said, pretty hands-on if the entrepreneurs want us to be, and usually they do. Kind of started and it's something you'll appreciate, I'm sure, being down in Scottsdale. But when we started the firm, had the thesis of you can find great companies everywhere. So we're less focused on, the Valley, Boston, New York, when it comes to sourcing new investments, and more focused on kind of everywhere else. So yeah, that's the scoop.
Yeah. And you completely have an outbound sourcing motion.
We do. I mean, we definitely welcome, any inbounds and appreciate inbounds. But are heavily focused on outbound sourcing.
Yeah, I feel like if you're playing the game that you and I are playing, which is, more economical type of deals, like the seed funds, they're incented, they're playing more venture games. So they're really incented to show the deal to the highest bidder. So there's nothing, if you're seeing it, everyone's seeing it.
Right.
And you might actually be seeing it last, right?
Totally. Totally.
Especially if you haven't seen it at first. So, I've completely went and actually based on your recommendation and some others, I've just gone completely outbound with us just because we've just found it so much more successful.
Yeah, no, it's true. I mean, it's very true. I do, I still have standing calls with folks at other firms upstream and downstream from us. And, we trade deals and, maybe they weren't the perfect fit for us, but they would be for them, for any given reason. But, I do get a little worried when, especially when you triangulate, like someone else in the firm said, oh yeah, I saw that deal from from somebody else. Then, like everyone's seeing it.
Yeah.
So
that's a dirty deal. Yeah.
Yeah. Yeah. And you never know. There it could be, great company, good deal, but we do like to find ourselves in more proprietary situations where we're kind of one of one or one of, 3, not one of 50. It actually kind of turns me off and you've probably been in this situation too, when I'm on the phone with an entrepreneur, I ask them, I say, who else, how many folks are you talking to? Or, how can you tell me about the process? And they're like, well, we had, 30 investor calls in the last 2 weeks. It's like, well, great.
Well, right, because they're trying to nag you into moving quicker, right?
Yeah.
And whether it's true or not, you're kind of starting off with the bad intent of optimizing for valuation, right? So
totally, and I get it, but I don't know. I don't think any investor wants to be one of 30, right? I'd encourage entrepreneurs to do as much work as you can ahead of time, not only because it'll make your life a lot easier, but try to find the firms that you think would be a really good fit for you, and it'll make it a easier process and a better process.
Do you ever run into this? Because I do, for searching for bootstrapped or capital light companies that are off the grid. Generally, they might be in that persona of being growers, high margin businesses, but they're a little long in the tooth. They might be 7, 8, 9 years ago, and there might be something economically that happened that, all of a sudden gave them a pop in their growth, and they're growing a little bit quicker, but, they're a little bit older. How do you think about those?
Yeah, it's a good question. I mean, we're probably less focused on how old the business is as a whole, and more focused in on, what has the growth been lately, assuming it's not coming from some,
COVID
abnormal
bullshit, right?
Yeah, exactly. If all the telehealth companies during COVID, right? It's
right,
okay,
right, exactly.
I get it. You're growing.
Let's pull through. Yeah,
you're growing like a weed, but and that'll last a year or two, but it's not going to last forever. And we're really focused on not only what's going to last and grow, continue to grow through our hold period, but whoever buys the business, they're going to want to make sure that there's still growth to be had. So we're not only thinking about our 5 years, but the next 5 years when we come into an investment. So, yeah, I think it's fine if the business has been around a little bit longer. I think the only downfall is sometimes we see those businesses, the tech is just maybe a little outdated.
Sure.
And this is just generally speaking, not, there's definitely unique situations. But if the business has been around, 10 years, the code was probably developed 10 years ago. And so if it hasn't been updated or kind of modernized, then, that could be a ding. But we wouldn't, hold it against the business for being around that long if all of a sudden it just took them a little bit longer to figure something out.
So you're a generalist, right? Generalist SaaS investor. Mm-hmm. Is there anything in particular that's really making you like super interested from a vertical industry trend perspective?
That's a good question. I mean, we've done a lot in like construction tech, residential and commercial. So we like those areas. We like prop tech. We've done a decent amount in prop tech in the past. But yeah, I try not to, we just made our first cyber investment, which is doing well. So I try not to like put us in a corner when it comes to areas, but as I'm sure, other folks on this podcast have said, you make an investment in, a space and you do learn a lot more about that space and you see more deals in that space and you become a better investor in that space. So yeah, we love it when we know the industry already, but try not to pigeonhole ourselves with,
Well, no, exactly. Because then it's like a circular reference, right? If you're not actually doing something, you're not actually ever doing something, right? You're just kind of going back and forth. And eventually you have to take the shot. You're not going to be able to underwrite every single thing.
Yep.
Cool. So what are you excited about this year?
I'm excited to, we're still hiring. So continue building up the team. I think obviously there's still a lot of, it's been a tough market, but there's a lot of great companies out there, and so excited to make some great investments and partner up with some great people. I know that's kind of a cheesy general answer, but it's true.
Awesome. That's fantastic. Sheldon, thank you so much for coming on. Everybody, thank you for tuning into the Capital Stack, where we talk to founders, operators, and investors about all things value creation. We drop an episode every Tuesday. We're on all your major platforms, YouTube, Apple, and Spotify. If you like it, tell a friend, subscribe, cancel me, do whatever, and I will talk to you next week. Thanks. Bye-bye.
Thank you for tuning in to the Capital Stack Podcast. Make sure to share this with someone you know that can benefit from this content. Remember to support this show by rating, reviewing, and subscribing. David Paul is the founder and general partner at DWP Capital. All opinions expressed by David and podcast guests are solely their own opinions and do not reflect the opinion of DWP Capital. This podcast is for informational purposes only and should not be relied upon for decisions. David and guests may maintain positions in the securities discussed on this podcast.